Hey guys, Jeff here. Today we are going to talk about liquidity. The concept at its core means orders are there waiting to be filled, or the market sees a place where orders should be and go ahead and place them when price gets there. So in other words, if you place a long order or a short order and it doesn't fill like instantly, that means you have zero liquidity in that spot. The thing is about unfilled orders, which, orders waiting to be filled, it's almost like a magnet. Another way to word it is that price seeks liquidity to fill any imbalances left behind. Now, there's a lot of different ways we look at the charts to find liquidity. One of the most common would be your FEG. Like, for example, we have an FEG right here. In this box right here, that is a fair value gap. If you don't know what a fair value gap is, by all means, check the link in the video. Check a link to the video in the description below. I'm not going to go over what that is. But that right there, my friends, are unfilled orders. So there is liquidity lying there. There are other ways, and we're going to get into that later of this video. But for now, let's keep on the base concept here. What these pockets of liquidity do, what these pockets of unfilled orders do, is they fuel further moves. Accurately finding pools of liquidity is key, is very important to finding the next big move. We're not just talking about these little itty bitty candles, but we're talking about bigger moves. So when price finally reaches, when the magnet happens and the price reaches these areas, that's what we're talking about. It's going to fuel a big move. And we're going to show you some examples of that a little bit later. So when you're talking about liquidity, it's important to talk about a very common term that you're going to hear a lot called inducement. First of all, I hate the term inducement. I really do. It assumes that there is some evil trader sitting behind a screen in a dark room, rubbing his hands together like Montgomery Burns from The Simpsons. You hear this a lot in trading. I was manipulated or tricked into taking that trade. I only failed that trade because of induce. I was induced and I was tricked. All right, well, I believe these traders, I think it's more of a coping mechanism for making a bad trade. There really is literally no evidence of something like this happening. Instead, it's more important to know what the market is doing, that there are orders waiting that need to be filled, and that price often follows the same patterns over and over. Now, the term inducement itself boils down to the institution tricking traders to take the other side of your trade. So the biggest example would be a failed breakout. And we can very, very easily see failed breakouts all over the place if we sit there and we put them on the charts. Basically, when you see a triangle and then the triangle doesn't do what you would have expected it to do. Here's one right here. All right, so right here is what we call a failed breakout. So this is a triangle. You see beginning traders draw these triangles all the time. You never see me draw these triangles because they're bull crap. Then we have, oh my goodness, we're breaking out. The crash is ended. And then immediately it comes back down and we crash back down. This is, my friends, a prime example of a failed breakout. This is inducement key 101. And one of the things that I'm going to show you right here as to what happened here is the next term. The next term that I feel is far more important than inducement are equal highs and equal lows. Right here is a very solid example of an equal high and an equal low. You have, let me get the magnet on here. You have this level right here. It doesn't have to tap it. You can see it almost tapped it here, but it didn't. When this happens, right now, the market is anticipating price will return here. So orders are going to be placed. They're going to be placed here because when it's already hit this level once before, it's predicted that it will hit it once again. And it did. and it blasted through it. And then it even stood there for what, 8 more days, something like that, 6 more days. And then what happened? It fueled a big move down. And when I talk about a big move, it doesn't have to be a giant candle, but we're just talking about a significant price drop. We went from almost 50 all the way down to almost 25. So that's half. That's a 50% move. That's massive, my friends. And I'm sure you guys remember when this happened. This was a year ago, almost to the date. Actually, look at that. It is to the date. A year ago to the day. That's just a coincidence. I just picked a random spot on the chart. So when you see equal highs, and now I'm not saying 100% it's always going to do this, because you never know what's going to happen in a news event or whatnot. But again, that's what trading is all about. Trading is all about predicting based on patterns that you see often, right? Nobody is 100%. Nobody makes 100% of their trades, but the more confluence you can add, the better your success rate will be. And even at a 50% success rate, you can win, depending on how tight your stops are. So we have equal highs, right? And what ended up happening is the price reached that level and came back down. So why did that happen? So basically what happens is breakout traders have a stop order in place or are watching the chart. And they say, hey, breakout! I better, long or sell, depending on what direction the breakout is in. And what ends up happening is their orders are really just the fuel that bigger traders needed to fill their opposite order. So in this example here, smart traders, they had shorts ready here. They had stop shorts ready here. So when price hit that level, not stop shorts, I'm sorry. They had short orders placed, limit orders placed. And when prices hit that level and all of these foolish breakout traders are longing, all they're doing is filling those unfilled, much larger orders. And that's what they needed. They see that liquidity there. They know it because they're generating it just by looking at the chart and know immediately that their orders are going to be filled because breakout traders are going to do what they always do, and they're going to go ahead and fill them. But you, my friends, can be smarter than that. You, my friends, can do what the smart traders are doing, and you can take advantage of the fools as well. Now, it's important to note that, again, it's not always going to be perfect. Sometimes equal highs or equal lows fail. That's just the way it works. There's other areas of confluence that's going on right here as well. So this is clearly an equal high, right? But when you're looking to trade it, you want different levels of confluence to give you confidence that this is going to happen. And what we actually have right here, we have a supply zone. Turn magnet off because it's not going to work. We have a supply zone right here. An incomplete supply zone right here from this to this, also an FEG as well. And what happened right here? After we cleared those equal highs, we tapped it. We literally tapped it and then dumped. This is trading 101 right here, my friends. We literally tapped this zone, cleared the FEG, and crashed. Couldn't be more clear as well. But there's other things to keep in mind too. So liquidity is super important, but it's not the number one trading direction that you're going to take. You have to look at a couple of different things. You also want to know market structure, and I'm going to be linking that in the description below as well. You want to follow market structure, and you want to follow demand zones, supply zones, and demand zones, and then you look at your liquidity concepts from there. And I mean, there's a lot of different ways to see liquidity on the chart. Honestly, just a wick, right? Just a wick is a very strong sign of liquidity, especially these long wicks like this. Because when you see a long wick like this, that means that the price moved so fast that it almost certainly left something unfilled. Almost certainly left something unfilled. But here's an example of where, see, there's a bunch of liquidity here, right? This is huge. But price didn't really move very far in the other direction from here. Why? Why is that? Well, because market structure is more important. And market structure is down here. I don't have the lines drawn because this is not the right chart. I think I might have them drawn here. Wow. Smash much? Where was that? It's right here. Yeah, see, here's your daily charts right here. This is a bearish structure, a bearish market structure. Is this the right spot? No, it's right here. I don't have the lines drawn here, but this was a chart anyway. This was a bearish market structure on the daily, and at this point, once it broke that level, it became bearish on the weekly as well. So the very first concept you need to consider when trading is going to always be market structure. From market structure, you need to then you're going to look at demand and supply zones. Then you're going to look for pools of liquidity for your entries. So this right here, this is a very clear and present bearish structure right here. So that is why we did not go up at this point. This is a very bearish line, a very bearish structure. So what other ways can we find liquidity, right? So there's wicks, and when you're talking about equal highs, I mean, obviously these are two wicks. Usually the equal highs, equal lows are going to be wicks. Very rarely is it going to close at the bottom of the candle like this when you're looking at equal highs or equal lows. It can happen, but it's pretty rare because you're usually looking for pretty big moves in the same candle. Another way to find liquidity is going to be trend lines, and trend lines is another prime example of breakout traders. Let me see if I can find a good one. This is a good one right here. So we have a trend line right here. Pretty significant trend line right here. So what we're looking at for trend lines is almost the reason why price continues to follow these lines is because of stop orders chilling above these wicks. So you're pretty much always going to see liquidity on them, and sure enough, that's what we saw here. This is what we saw here as well. Now this is an example of a switch. We actually are entering a Wyckoff accumulation. So keep in mind other areas of confluence as well. Like I said before, these concepts are not 100% gold set in stone. They don't work forever. The market structure is not going to be bearish forever, right? It's eventually going to flip and go bullish. And you may have a losing trade when that happens. Because like for all intents and purposes, I mean, we've been in a bearish daily structure for like a year and a half at this point. So why wouldn't it just continue to be bearish? Why can't we just keep shorting these trend lines down? Well, you're going to lose some trades. That's just the way this market works. But the more confluence you add, the more successful trades you can have, and the better luck you will have. Right here we have an example of another trend line. Right here, it's not a very good one. To be totally fair, this is not the best. Let's try to clean that up a little bit. Not the best trend line I've ever seen, but it is one. This is an example of a trend line. So right now we've got liquidity building over this. Can we pull this back? Is there anything? Not really. There's some liquidity building here. Maybe from here to here, would that be better? No, this is a better trend line here than that. So more than likely what we'll see price action, do whatever it does. It'll probably tap this and it'll probably come back down again. Typically, I mean, the golden rule, right, is 3 taps on a trend line is about what you would expect before some sort of move in either direction. So if we're following liquidity concepts only, we would expect a breakout of some kind from this trend line and then a crash. But if you're also following market structure, and if you watched my video the other day, you know that market structure actually turned bullish. Right here, it turned bullish at this chart right here. So if we're going to follow market structure first, before we're going to follow liquidity, we're looking for longs right now. We're not looking for shorts right now. So you got to be careful, and you need to find a different source of liquidity. I don't see any equal lows that would fuel some sort of a pump. But if for some reason this does happen and we come down here and we make an equal low here and then we start to do some business here, we can very, 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 very likely expect a pump from there because we are in a bullish market structure. There is a very clear zone left behind right here on the daily. This demand zone right here is a pretty good one. And there's even another one right below it too. In fact, we could probably encapsulate this whole box right here and consider that to be one large demand zone. But if we're if we want a pinpoint trade, we're really just going to be looking in this little box here. But right now, if we can see some sort of equal low form, and then we're looking at this demand zone here, I would feel very confident that we'll hit 2 spots of liquidity. Let me draw a better path here. So let's say we do mess around here for a little bit, and then we do wick up and we tap this trend line a third time, but we don't break through and then continue up. I could very strongly see price coming down here, spending a little bit of time here, and then coming down here at this FEG, spending a little time here, and then I think I would see a lot of traders longing from this point. I would be hesitant to long from this point, and I believe I mentioned that in my last video. I'm not looking to long this right when it hits it. I want to see what price does when we get here, because if we break down from here, it's potentially pretty bad. However, I would be looking for us to enter into this demand zone down here, and then we may enter into it down here, and we may just fly from there, because I believe there's a very, very strong source of liquidity waiting here, especially if we form an equal low, come back up a little bit, and then come back down into this demand zone, and then we'll just fly from there. So I will be looking to long if this scenario plays out. I may also be looking to short this trend line up here, but this is not the best trend line I've ever seen. So I'd have to see what the candles are doing at that point. So that's pretty much it, my friends. So to wrap it all up, what you're really looking for to find liquidity on the charts is you're looking for wicks, and you're looking for trend lines, and you're looking for equal highs and equal lows. Those are your big 3. Of course, there's still fair value gaps where you can see there will be some liquidity left behind. And of course, there's also supply and demand zones. But we're really looking for unfilled orders, and that is what liquidity is. And stop saying you failed a trade because the market manipulated you. It's bullcrap. It's bullcrap. You're not failing a trade because the market manipulated you. You're failing a trade because you're not a good trader. I'm sorry. Well, you know what? Let me rephrase that. If you're under 50% success rate, you're not a good trader. Let me put it that way. And that's just because you FOMO'd into something. And those are breakout traders. Breakout traders, they're FOMOs. You're missing out. But that's going to do it, my friends. Please leave a like, subscribe to the channel, comment below if you disagree with me, or visit me on the Discord server, also linked in the description below, and come have a chat with us. We are more than willing to discuss things with you. We also have a Telegram, which you can find from our Discord server, and we have signals and whatnot on there. So please come check us out. Take it easy.